All right, so in 3 days, we've totally reversed the 5-day losing streak that we had last week. So, okay, are we back to it, right? This is what we want. Are we going to break up to these new highs? How much more do we have left to run? Was this enough of a pullback? We got some more data and feedback on that here today, so I'm going to bring that up. Take a look at what's driving the price action today. See how that impacts those expectations, and then of course our trade idea would benefit no matter what the market does. If it, in this kind of noisy up and down, our trade idea will be able to wade through all of that. So let's go ahead and get started. Today is Wednesday, March the 13th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the nice little ramp up we've had in the last 3 days has essentially got us right back up to the highs of this, right back up to that 78% Fibonacci retracement level of the decline, right? Because we're retracing this big decline. 100% retracement would get us back up to 29.41 essentially. So we're back up to that 78% retracement. We're back up to the highs of a couple of weeks ago, or at least last Monday actually, where we opened up last Monday. We weren't able to quite get through it yet today. We'll see what happens tomorrow. Obviously the moving average is bullish. The market posture is bullish again with the intermediate line turning up, and already that close to the end zone, so to speak. Getting into the upper reversal zone, which suggests. So we really, again, because it didn't get below 50, this was not an intermediate pullback. This was just basically a short-term, a deep short-term pullback, because it brought the near-term line all the way down here instead of just below 50 like all these others. But it was just essentially just a near-term pullback. It's 5 days in a row, and I think there's a lot of stock that got put into that. It's like, well, hey, here's a correction, but the reality is, how many days before that 5 days in a row did we go up? So you can, as I said before, we didn't even on Friday get down to the 23% Fibonacci retracement of the rally. So I mean, it's just a near-term pullback, a little deeper than normal, because it did bring the intermediate line, or the momentum line, down here. It didn't quite get below 5, so it didn't quite get to an extreme. And the near-term line did get into the reversal zone, but not as deep as we've seen others. So it was basically just a deep short-term pullback. So we're still riding this intermediate rally. You can see there's other near-term pullbacks too. So this isn't the only one. This is just a deeper one than what we've seen. We're rallying higher, so consider this continued. Despite that little pullback, this is still a continued run up to the upside. In fact, I actually need to, because I think we did get up to a higher high. The high there was 28.1688. Here, let me get to activate that. I think we actually did get to a higher high today. We did. So we're up to 28.21 is what we got up to today. So slightly higher high than what we saw last Monday at the open. But again, you can see where the 23, how the Fibonacci retracement levels line up with these old retracement levels from that tremendous drop that we had. So again, you can kind of see where support will be, especially with Fibonacci fans really close to crossing. So you got the 38% close to crossing the 23 at that level, where support could be if and when we ever do get an intermediate pullback, because we will at some point. The intermediate line won't go up forever. You can see it, typically it's 1 to 3 months where it will be up, and we weren't really expecting it to continue here without the pullback basically in this area that we never did get. So this is all still that same time frame. We crossed above 50 here in we're 2 months into this essentially. That was January the 11th. We're at March the 13th. So we're 2 months in. We can expect another month if we continue up without that exhale that we've been looking for quite a while. And as I mentioned before, just because you expect an exhale doesn't mean we don't trade bullish trades, as we've been doing, and as we've been doing in our classes. Like yesterday, was it yesterday's? Yeah, yesterday's directional option strategies class here at Market Scholars. We all of our trades that we made were bullish trades in that one, simply because that's what we were getting. So we just manage our risk with those, knowing that we've got to, we don't have as big of a margin of safety. We're walking a tightrope that's a lot further off the ground right now than say if we had bounced and had formed a low point and we're bouncing off a more solid low there. And you can see similar patterns and everything else. The Dow Jones not as bullish, obviously we know why, because of Boeing. And the Russell 2000 also not as bullish. So that's a little concerning too. That should be leading our way up to new highs, but it's the large cap index that's leading our way up. So the small cap led our way up off that low, but now it's that large cap leading the way. Not necessarily the most bullish of signs either. Intermediate posture is bullish, but it's barely at midfield, across midfield, whereas the S&P was knocking on the the 1 yard line. So you can see the difference there in postures. Now, before we look at some other charts, subscribe to our YouTube channel if you haven't already. Mouse over this logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Down below the video, click the thumbs up icon. That tells me you want me to do the video again tomorrow, or me or Brandon. You want us to do the video again tomorrow. Quick way to give us feedback. You can do that right now, actually, while you're watching. Also, down below, comment on anything that stood out to you in today's video. Let me know what you got out of it today. Join our Daily Market Outlook email list. There's that link that's popping out right there. Quick, easy way to subscribe to that list. Follow me on Twitter for more content in between videos, and join our Market Outlook community that we created on Facebook. As always, a few quick things to highlight on the blog that you may be watching this from. There's our video. Right above the video is a link to participate in the Market Outlook forums with other market scholars. There, you have to subscribe to our site to do that, but you can do it for free. Subscribe right there by clicking on that image. There's our calendar of classes coming up. And then over here you have today's Market Outlook tweet and today's Market Outlook Facebook post. So if you engage with those posts, then Twitter and Facebook will keep pushing you the content that we create. So the way that you do that really easy, click this heart button right there. You can see we got really close to 100. Hit the like button when that pops up, and then click this image. It takes you to your Facebook page. You can click the thumbs up icon there and share it with people too that you think might be interested in this type of content. Alright, back to the charts, and you can see, we bounced up so far this week. We got 2 more days left, but look at the week compared to last week, and big ups and downs. When you look at the Heikin-Ashi candles, it smooths it out. So you can see that even this week is a transition week still. So we can still, despite the big down week last week, the big up week this week, you can see from a trending standpoint, they're both as kind of neutral weeks because we've been so far up. We can still get a reversal to the downside. We can still get bullish candles to the upside too, like we did over here. Instead of transitioning up, we continued down. So keep that in mind, what kind of candle we get next week, whether it's bullish or bearish. So we expect it to be a reversal because that's what you typically get. But that doesn't necessarily mean we will. So we'll kind of keep our eyes out on that. And then if you look at the other trend strength indicators I've brought up before, you're on a strong trend. Remember, this is a weekly chart, but you're on a strong trend when this number gets above 1, and we're at 1/3 of 1, and when that number gets above 50. So you can see that even because you have to keep in mind from a long-term viewpoint, this is a big rally we're on, but it's still only 78% of the big decline that we were on before. So we're not back to, you go back to here, to March of last year, and we're just barely up year over year. So that's why these indicators are showing that we're not really on a bullish trend, a strong bullish trend yet. We're still kind of noisy here. So keep that in mind when you're considering, okay, full steam ahead. These long-term indicators suggest not quite. This is still pretty noisy when you look at the big picture. When you look at this on a daily chart, it's a different story. We're above 80, we're above 5, we're on a strong daily trend, but that hasn't translated yet into a strong long-term trend. We're still really, really noisy from pretty much all the way from January of last year through the ups and the downs. We really haven't taken off yet and re-engaged a nice good bullish trend again. From a 3 green arrow perspective, we're almost back to 3 green arrows. That MACD is still struggling. We had that pullback was enough to get that MACD pretty far down below its moving average. So it hasn't crossed above its moving average. That's what gets you the green arrow there. But we are above all 3 lines. They're all 3 rising. Stochastics is above its moving average. So you've got we're kind of re-emerging into a bullish. But remember, we haven't had the intermediate exhale yet. So as bullish as we are, we can still walk a tightrope. We can still get to the other side. Just keep in mind the risks that we're at right now. There's a we're a lot further off the ground now than we were back here. So we just have to keep, without a pullback, we're a lot further off the ground. We haven't established a new ground yet. That didn't establish a new ground because it wasn't enough of a pullback relative to the rally that we had that preceded it, and relative really to other rallies, pullbacks that we've had previously. All right, now let's look at the intraday moves here. This chart right here. There's the higher high and a higher low. We gapped up, so we have to keep that gap into account here. We closed yesterday at 279.44, and the low point was $1 higher almost. So that's overnight trading that we have to account for when we're looking at the day's range. We actually went lower on the futures and then bounced up. So, but that's where we're at. You know, higher high and a higher low. That we did get above last week's high point, got up to a new 4-week high. Someone mentioned, and so I'll mention that this I talked about before, that this low point would eventually move up here and shrink up the trading range. Well, this low point over here that I was totally not looking at would actually keep the 4-week low down. So we came all the way down to this low that we're at, and that's pretty much where it's going to stay now. So because last week's range, basically, absent this little rally we had today up above it, but last week's range essentially now will become the 4-week range, with that little move up and a little move up on the line to the bottom side. And that will be the 4-week range for a while, because again, you're bullish when you have this sticker way over here on the left and this sticker way over here on the right. That's a bullish pattern. To get before this rally, we had this bullish sticker right here, and then the low sticker on the right side. That's not a bullish pattern to have the low sticker on the right of the high sticker. So this nice little rally has helped out a little bit, but you notice they will stay really close to each other. They'll pretty much move, unless we move up to new highs, these two will move together all the way across this chart. So at least the low is on the right side of the high, or left side, the correct side of the high. That's a positive. You see a lot of volume kind of coming here at the end of the day. If I look at the volume in context here, so we'll look at this 3 green arrow chart with the volume, you can see that's one of the higher days of volume that we've had here during this little run. 80 million here. Yesterday we got up to 70 million. The range, like I said, was at 2.08, but you have to add in about another point. So we're a little bit above average on the range. When you look at it, whoops, not that one. This one here. When you look at that in a range, we were just a little bit above 1%. So we're still kind of, and you can see volume. Remember, volume is ticking up because it went so low on those zero volume days that we have here that still haven't been corrected apparently by the platform. The trading range also is lower. The ATR is lower because of these zero range days that we had that's really bringing that average down. So the reality is we probably would be gradually moving towards those anyway, because that's about where our trading range was. We're at, we're getting 2 points. Yesterday was 1.25 points. We had a 3-point range there, but 2.25, under 3, it's over 2, 1.35. So even the down days were not that big. So we probably would have eventually gotten down to this on the ATR. We're not like abnormally low, the 52-week range. Where like volume, that's an incorrect number. That would be probably corrected up higher had these volume amounts eventually get put back in. So, and you look at the volatility, and we actually looked at this today. Volatility is at a low point again, and it's just a smidgen below the neutral range, but it hasn't really, kind of gotten down and now stayed here. We've been here before. We've closed days below 90 before. Yesterday, and then again here you can see today. Last time here we closed below 90. We rallied in volatility. There's that decline, right? Over here we closed below 90 and we rallied. So okay, we've closed below 90 now 2 days. Are we going to stay down here, or is it going to produce a rally like we've seen here in the most recent past? If it follows precedent, then, like I said today in today's options inventory class, we actually added trades to take advantage of any potential rally. Looking at that on the chart. And you can see if I look at a weekly chart here, we've closed weeks below 90%. That week and this week only to get a rally. Here so far we're closing another week below. We'll see if that ends up holding or not, because it couldn't hold these last couple of times here. So to summarize, the market posture is bullish. We might not be as comfortable with it, but it doesn't mean that we can't trade this trend, this bullish trend, like we have been in our classes. And it continues to be bullish. And there's a strong momentum for it right now, and that's not something you want to fight. It doesn't mean that at some point we won't get that intermediate pullback, and it could occur sooner rather than later, and we're expecting and looking towards it. And it would be healthier for us if we got it, but it doesn't mean that we have to sit on our hands until. In this way, because that's the fear of, that's the pain trade. And in fact, I think that's one reason why the market's going up as much as it is, because people have been sitting on their hands waiting for that pullback and not employing cash at all, not even to a small extent like we've been teaching. That now the pain trade has been the fact that they've been missing out, and as more and more cash gets deployed, then the pain trade will be back to the downside. And if and when that occurs, it could be pretty painful, because the majority of the money coming in at the end of this rally, instead of nice and healthy throughout in small doses throughout it, will make it a little bit easier for the selling to get larger than what we may be comfortable with. So what do you think of that outlook? Do you agree or disagree with that? There's a link popping out there. Click that link, opens up a poll, then hit either agree or disagree. If you hit disagree, scroll to the bottom, comment on what you're seeing that would suggest otherwise from what we've talked about here today. All right, now let's take a look at what's driving this price action. And if I were to bring this chart up, you can see the biggest winner today was crude oil. I did tweet that out. I don't know how many of you follow me on Twitter, but if I bring this up over here, I did tweet out earlier today that crude oil has been, this is since I actually left on vacation and since we've come back. But crude oil has been a pretty big driver of this rally that we've had. I mean, you can see it kind of held up. A little bit of a decline here, a couple declines that kind of put some pressure on stocks. But it's off that low point. You can see, we're 6% because it was down 1% and now up 5.25%. And that's really helped stocks come up. Now you notice it hasn't helped small cap stocks. Small cap stocks are still kind of struggling and really underperforming the broad market over this past few weeks, as well as emerging markets. So those two have been pretty decent winners previously, and they've been lagging behind a little bit. Those are your riskier asset classes. So those are, aside from crude oil, those are kind of your higher beta that you want to be on the other side of SP, of that black line, not on this side. So not as bullish as we would like or could be. But one thing to consider about crude oil, and if I were to pull up that chart, this is the chart I tweeted out today. If I were to pull it up now, this is a chart for crude oil and what it could be doing. You can see that we broke up above the Bollinger Band. This is yesterday. So we broke up above the Bollinger Band. Nice good breakout. We broke up above all these highs. And you notice from the volume profile, we broke out of this little volume area that we've been in. We've really kind of built up a volume node, and we're breaking into a volume vacuum, which will draw us up through this Fibonacci retracement zone, up out of it into 65 and beyond, where the next major volume area is. Just a little bit below 70. That's the next layer of resistance. So, if that ends up being the case and crude oil breaks out here, then that's, as we've seen, there's a strong correlation between crude oil and stocks. That could help bring large cap stocks up. So we may be bullish here for a while on equities. Another big story has been the 10-year note. Right? As bullish as we are in stocks, you notice that the 10-year is not confirming that. So the 10-year continues to be actually pretty bearish, and that's widening. It's getting more bearish. The volatility band is widening here, the Bollinger Bands. So we're getting more bearish as that line rallies up. So that's not a good sign when the bond market's not confirming what the stock market's doing. Eventually I'd rather be on the bond market side of the market. More money, so it's generally considered a smarter market. So it's a little concerning. Again, not concerning to where I'm not going to make any trades, but definitely concerning enough that when I do make bullish trades, I'm that much further off the ground, walking that tightrope. So I really want to make sure that I'm covering my risk and managing my risk the best that I can with smaller positions, spreading out my risks, different strategies, all sorts of things, so that if and when we ever do get a pullback, if we come off of that tightrope a little bit, it's not going to hurt me nearly as much. Whereas people who are kind of going all in because we're really kind of breaking out, would be hurt a lot more because they've gotten in so late with bigger position sizes, with the normal to bigger position sizes. Another story too is that dollar, right? The dollar was supposed to be breaking out. I mentioned in my portfolio management class last Thursday that usually when you get this kind of breakout move, that's one big move on the dollar, as we've seen in the past, you tend to get a reversal. And so we were looking for a reversal on the dollar in that class and throughout this week, and so far we've gotten it. Look at the dollar really starting to pull back here. So, eventually the emerging markets have been lagging behind. You can see here's SPX I've got highlighted. And then here, EFA has been doing well, the developed markets, but emerging markets have been lagging. If the dollar keeps pulling down towards these lows and into this half of the retracement zone, Fibonacci retracement zone, that's going to be actually pretty bullish for emerging markets. So that's an area, if we are going to be bullish in the markets, that's going to be an area that's been a little oversold that we can take advantage of. Now, when you look at the calendar today, in the last couple of days, we've had CPI and PPI. If you look at the year-over-year rates, which is what really matter the most, we saw CPI's year-over-year rate was coming down, but look at PPI's year-over-year rate on the core level and a headline level. Really, really coming down. Now, that's actual inflation. If you look at inflation expectations, which is this 5-year forward inflation rate, if I were to zoom in and move all the way over here, and you can see we're only updated as of 3/12, so that was yesterday. But you can see inflation expectations are back down below 2% again. So that is actually going to keep interest rate hike odds down. So I know there's a lot of people expecting yield to go up. A lot of really smart people that I follow online. But without inflation expectations rising and without rate hike odds rising, it's going to be hard. And with economic indicators as a whole as bearish as they are relative to their estimates, which usually means that they're coming down, they're pulling back. And you can see even GDP estimates still, they're up, but they're only up to 0.4% growth for the quarter. It's going to be hard for yields to go up as it is. So it's going to be hard for yields to confirm, and look, you can see a little bit of a flag pattern developing here. So you'd expect kind of a bigger drop to the downside, similar to this drop you have. That's not the most bullish either. So, stocks may continue to be higher, but again, the macro environment is kind of setting up for that intermediate pullback that we're not getting yet, but we could sooner rather than later. So, again, with that risk factor that's out there, doesn't mean that we have to avoid bullish trades. We just need to make sure we're managing risk. So if and when that does come, it doesn't kill us, right? It doesn't kill our accounts because we went so all in on the current really strong trend. All right, if you take a look at the sectors today, they were all up. Utilities and communication services were down and real estate down. Those are your interest rate sensitive areas. They're going to underperform in a falling rate environment. So they have been outperforming really well, but they're lagging behind here. Energy and industrials, not quite materials because gold stayed down, but energy and industrials, you can see materials kind of lost a little bit here. It was one of your best performers initially on the day. Along with energy here and industrials. Energy rallied, materials pulled back. But it's kind of a weak, see, when the dollar is weak and pulling back, you would expect energy, industrials, materials to outperform. If I were to go back just a couple more days here to this kind of 3-day drop that we've had in the dollar, you can see there's energy doing really well with that rise in crude oil. Materials kind of matching the market, and then industrials lagging behind simply because of Boeing. But I mean, considering it's still up despite Boeing, as much as Boeing has dropped, industrials is up because of, I mean, just think if Boeing was just matching the market returns, industrials would be way up here. You can see also technology doing really well. Not quite as well today, but doing well. Healthcare up, and financials, couple lagging sectors. So I think what you got right now is you got the broad market outpacing, and you've got some lagging sectors. You got a little bit of rotation to bring up these lagging areas. They didn't do as well during this rally to the upside, right? From the Christmas Eve low point here. Here's our Christmas Eve low. We'll just go to a daily chart. You can see, there's healthcare. Healthcare was lagging behind. There's real estate, and then materials, and then financials is here. Where's financials? This orange line. You can see it's been lagging. It's had some outperformance really initially. Then it kind of went sideways while the market rallied up with some other areas like technology and industrials. And you can see technology still leading and industrials lagging because of Boeing. Communication services and discretionary leading too. But I think now you're starting to say, okay, let's rotate some of these others. There's discretionary, there's communication services, there's technology. They're going to slow down, and some of these other areas that have been lagging or not performing as well will start to move up while we kind of get this last leg higher, however long that leg takes us. All right, one stock that's been doing well, it's in that technology area off that Christmas Eve low point right now. Here's that Christmas Eve low, or actually it was right over here. It was a Christmas Eve low. And we bounced up, then it came down here, and then earnings have been rallying back up into that area. But because of that Christmas Eve low and the sideways range we've had, it's got a really big amount of volume in this space. And we're kind of stuck right at it, even getting above this volume node, the highest one, smidgen above it, or right at it essentially. There's going to be a lot of resistance. It's going to kind of muck around, even to the downside. You've got some volume support here, as well as a broad market support, and earnings coming after April. So if it's going to kind of muck around here sideways, one option that we can do is let's say, okay, well let's sell both sides. We'll go to that, try to get 30 delta as close as we can, sell the 52.5, 50, and then come over here, and we can do one of two things. We can sell the 60 and buy the 62.5, and that gives me a higher probability trade. It's a smaller credit. For $2.50, remember we're typically going for about 58 cents. So considering that we have two verticals here, we should get some more. If you take a look at that, now I can also go to 57.5, 60. That's the other option. I get a much higher credit, but a lower probability. If you notice, whenever I take a look at, there's my two options right there. There's the higher probability trade and where it needs to stay, and then there's the lower probability trade. So it's got a higher reward, but a smaller probability, 50% compared to around 60% for this. And so that's why I always like to steer towards the higher probability. You notice the break even on the upside allows me to fill in that space if needed. I'm still in the volume zone though, this 70% zone, but you can see to the downside my break even is right above that volume node, which will work to serve as a strong support to the downside, as well as the bottom end of the zone. So, and as this comes off, you can see the zone is going to come up. This line's going to come up a little bit because that's going to come off within another month. The volume that's in this area. We've got about another month left in this trade towards that April expiration. So it's a way for us to say, okay, it's got a low bandwidth. It's not really going anywhere. I'm getting enough credit for that $2.50 wide spread to make the trade worth the risk. The stock is not, it's on a bullish trend, and it's got, so it's if I am worried, if I do want it to go one direction, I would much rather go slowly to the upside than to the downside, because I've got more room to work with to the upside. And it's got a bullish posture. It's just weak. It's the market sentiment's barely crossing above 20. If you take a look at the long-term averages here for Qualcomm, you can see how we've kind of hit these areas before. That's why I'm still feeling pretty decent about that support. And we've got that range to fill in towards the 200-day moving average. That's why the upside is going to be a little bit more limited, similar to here. So if we get this kind of move right here over the next month, then we'll take it, right? We'll take it, and that's kind of the idea behind this trade. All right, so that's what I have for you. Now I want to hear from you. Remember to use that link that's above the video in the blog post. That takes you right to our Market Outlook forums. Open up a new thread. Let me know what you're thinking. Any questions or comments, or any about what I talked about, or about anything I didn't talk about. And also remember, you can reply to other people's threads there too. You have to subscribe to our site to participate in those forums, but you can do that really easy for free, as I showed you on the charts. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Give a thumbs up. Click on that thumbs up. Click those like buttons on Twitter and Facebook, and then follow us for more content on those social media comments as well. Follow me on Twitter. Join our community on Facebook too. Have a great rest of your evening, everybody. Thanks again for watching, and we'll see you next time.